Hi viewers, this is Dr.GUDIPATI, Assistant Professor of Commerce and Certified Financial Planner. I am here to present you the concept of equity investments. In this presentation, you are going to learn what is equity investment, how to invest in equity shares, what is the process we need to follow, what is the advantage in equity investments we are going to learn. Before going to start my presentation, I am requesting you all subscribe my YouTube channel Gudipati Srinivasarao. You will get all updates whenever I update my videos relating to the stock market. In this presentation, I have prepared the content mainly for the purpose of investor education point of view, not for any commercial purpose. So this presentation aims to provide the knowledge relating to equity oriented investments. Here I am not promoting any companies, any financial product. Now I will begin my presentation. Investments. Just go through that. Just observe investment. What is an investment? Simply, investment is nothing but a process of keeping our resources for generating revenue in future. So this is the general meaning of investment. So we will see each and every aspect in detail. Investment is not a number game, it is a mind game. So that we need to play the investment game carefully and consciously. So in my presentation, you are going to learn the aspects relating to what is investment, how to invest in equity share, benefits of investing in equity shares, risk in equity shares investing. This is the whole idea of my presentation. Before going to start main presentation, just let us have an idea of what is investment. In a common parlance, in a general meaning of an investment, putting our resources in somewhere for generating the revenue. So this is the simple meaning of the investment. Now we'll see that what is an investment. Once again, try to understand what is an investment. Here, investment is a sacrifice of current money or other resources for the purpose of future benefit. It may be any resources or any money which is sacrificing at present for future the benefits. Simply we are keeping our resources in a definite source of generating the revenue. This is also called an investment. Now, how to invest in equity shares? Why I have chosen equity shares? See, in my earlier presentations, I have given the clarity regarding mutual funds, how to invest mutual funds and all. Now this total presentation concentrating on equity shares and equity investments. See, the nature of equity shares, high rate of return and the higher amount of risk orientation. Now, you'll see that what are the various channels for investing in equity shares. There are two channels of investing in equity shares normally. We have other channels also, mainly focusing on two channels. So channels of investing in equity share, we can say the route of investing in equity shares. The channels of investing, once again I repeat, there are two channels. One is through IPO route. IPO means initial public offer route. The second way is simply the secondary market, means through stock exchanges and all. There are two important ways of investing in equity shares. Now let us see IPO route. IPO means initial public offer. Initial public offer is a process of offering shares to the common public for the first time. This is a simple understanding of IPO. It means a fresh issue of a company shares to the common public. In such a case, what are the pros and cons? We will see in this case. IPO. Just once again, go through the IPO. IPO refers to the process of offering shares of a private corporation to the public in a new stock issuance. Simply, we can say a fresh stock issuance. In this IPO, we have advantages. See that regarding the price, they will fix the perfect price normally. There is a lot of safety involved in this IPO route, and there is a possibility of quick short-term profits. These are the advantages. There are so many other advantages also. I have picked up most important advantages of IPO route. Now disadvantages. Here in IPO, there is a possibility of expenses little bit high. The second disadvantage is lower or no allotment in case of oversubscription. Suppose there is overwhelming response of the IPO. In such case, small investors, there is no possibility of getting the allotment. And third disadvantage is money locked. There is a possibility of money locked for the completion of the entire period of IPO. Suppose if you have an allotment, then there is no problem. Suppose if you are not getting an allotment, the total money of the entire period is locked. These are the advantages and the disadvantages in the route of initial public offer. Now we will see the second route of investing in equity shares. The second route, we can say the second channel, secondary market. Secondary market, what does it mean? The market where previously issued financial instruments are bought and sold. It is where investors sell to other investors, normally through stock exchanges. The secondary market is nothing but simply the shares were already issued, were traded in the market. This is nothing but a secondary market. In secondary market transactions or secondary market investments, here also we have certain advantages and the disadvantages. The advantage is the liquidity. See, what is the liquidity here? Whenever you want to sell your shares, there is a readily available market, so that there is a high amount of liquidity and the long-term returns. As long as if you want to be an investor, as a long-term investor, definitely equity oriented investments will give you the long-term returns. Disadvantages. There is a high amount of possibility in volatility in short term. Here, sometimes there is a possibility of brokerage can eat up into your profit margins. So, this is the scenario of secondary market investing. See, by taking into consideration primary market and secondary market, we can choose according to the situation the IPO route and the secondary market route. We have seen the two channels. The two channels are, once again I repeat, the first way is IPO. This is the most effective way of investing. The second way is the secondary, the market. I hope you all are getting what is IPO and what is secondary market. IPO is nothing but a fresh issue of shares. The secondary market means the shares were already issued and the trading is taking place between the investors. This is the secondary market. We have already seen advantages and the disadvantages. Now we will go for what is the systematic approach. What is the step-by-step approach for investing in equity shares? We will go through important procedure. The first step, for investing in equity shares, we must have a PAN card, because the PAN card is the important document to know the customer or to know the investor. And for income tax point of view also, the PAN card is a base. for any kind of investment, PAN card is the minimum requirement. So that you must have the PAN card. Second, find the stockbroker. See, how to find the stockbroker? Just do some little bit research, the stockbroker performance and the stockbroker activities, the charges they are taking. By taking into account these factors, identify the one stockbroker. After that, open one demat and trading account. So this is an important aspect. See, nowadays opening demat and trading account through banks also we can do it. This is the simplest process, just simple application, we can do that. So demat is nothing but dematerialization account. Your shares can be in an electronic form, so that form, if you want to maintain in electronic form, demat account is compulsory. For trading, for purchasing and selling of shares, you need to maintain one trading account. So that we need to open demat account and the trading account. After that, select the stocks if you want to buy. See, selection of the stocks. On what parameter we need to select, we will discuss. The first step is selection of the stock. And the fifth step is choose your stock order. And finally, investing regularly and carefully. This is the entire process of investing in equity shares. Here, at the time of investing in equity shares, we can go on our own, or otherwise we can give the orders to the stockbroker, so that stockbroker can buy or sell as per your suggestions, as per your orders. So that there are two things here. So one thing, you can go directly and buy and sell through your trading account, and another way is the giving instruction to your stockbroker, and stockbroker will buy on behalf of you. So there are two things. If you are well enough to understand the concepts of stock market, so that you can go directly the buying and the selling. Now see that how to give the orders, otherwise how to place the orders. What are the various types of orders at the time of the purchasing or selling an equity shares? Before going to place an order, you must understand certain terms, meanings, the carefully and perfectly. Here see that ask, we can say ask price. This is for buyers. Here ask price means the price that sellers are willing to accept for the stock. And the next one is bid price. For sellers, this one is the price that buyers are willing to pay for the stock. So that ask price, bid price. I think you got it. Now the meaning of spread. Spread means the difference between the highest bid price and the lowest ask price. So these are the terminologies normally which is used at the time of placing an order. Now see the different types of orders. Market order. What is market order? A request to buy or sell a stock as early as possible at the best available price. Like limit order, another one. A request to buy or sell a stock only at a specific price or better. This kind of order is nothing but the limit order. Coming to the important order, stop order or stop loss order. Here, in stop loss order, what happens? Just go through it. Once a stock reaches a certain price, the stop price or stop level, a market order is executed and the entire order is filled at the prevailing price. This order is given for the purpose of stopping the loss at a certain point. Coming to the another category of order, stop limit order. Here, stop limit order is when the stop price is reached, the trade turns into limit order and filled up to the points where specified price limits can be met. This is a most important order. Stop limit order, when the stop price is reached, the trade turns into a limit order. Limit order means we have already seen here. What is limit order? a request to buy or sell a stock only at a specified price or better. See, limit order is filled up to the point where specified price limits can be met. This is the situation. Stop limit order. I hope you have understood the various concepts relating to putting an order, ask price, bid price, on the spread, market order, on the limiting order, stop loss order, like that. Various terminologies we have seen that. So after understanding the concepts relating to placing an order, then we can go for the basics, the other important aspect which I have taken into consideration for investing in equity shares. Now see that. After getting the idea of all these terms, now understand the security market indicators, bulls and bears. So how market is going on, whether it is in bullish market or in bearish market. So bullish market means market is moving upward. Market is moving downward, it means the bearish market. Now understand the market situation, have a complete idea about the stock market indicators. After that, you need to understand the most important aspects, book value, the face value, and the market value of the shares. If you are able to understand these three things, then you can easily invest in stock market. See, three important values you must understand. The one is the book value, another one is the face value, another one is the market, the value. After having an idea of all these three, then we can simply go for equity investments. The first of all, what is face value? You should understand. The face value is a nominal value which is printed on a share certificate. See, every company issues shares to the public. At the time of issuing shares to the public, it specifies clearly each and every share value, unit value, that is nothing but simply a face value of the share. Now, coming to the book value of the share. Book value of the share means this is a liquidation approach normally. So what is book value approach? Suppose today if the company is going to close it down, so what is the worth of your share you are going to get? So basing on that principle, we can calculate the book value. So how book value is calculated, They simply take into account all the assets of the company, the minus all the liabilities of the company, so that net worth we will get, the net worth of the company. So that net worth divided by total number of shares, you will get the book value of the company. So now we have seen two values. One is the face value, another one is the book value. So another important one, the market value. The market value which is quoted in stock exchanges every day based on the demand and supply. Here demand and supply means buying and selling. So that value you will get it every day at the time of the closing of the market session. You will find out that day the market value. So that every day, every moment, the market value of the share prices may go up, price may go down according to the purchasing and selling activities of that particular company share. So here we have taken three important values. The one is the face value, the second one is the book value, and the third one is the market value. With the help of the book value, how to identify the good shares for our investment. Just go through it. After verifying the book value, face value and market value, in addition to that, you must do some research on fundamental analysis. You have to do some fundamental analysis. What is fundamental analysis? Before going to purchase any company stock, so you should analyze the economy, you should analyze the industry, you should analyze that specific company's position. This is nothing but simply the fundamental analysis, EIC approach. EIC means we need to study the entire economy situation, and the I stands for industry situation, and with respect to company. The movement of all these factors we need to study carefully. So after that, technical analysis. How the pattern, share value pattern moving, we can understand through technical analysis. See, all these things are with a little bit understanding, we can do it with our own. If we are not able to do it all these things, simply we need to follow the brokers or agent suggestion, we need to follow that. So, technical analysis. Technical analysis will give you the idea of the share price movements. So, after careful analysis of fundamental analysis and the technical analysis, then identify the underpriced share and overpriced share. So, if there are underpriced shares available, we can buy. If there are overpriced shares already you are holding, you can withdraw from that share. Now, what is underpriced and what is overpriced? See, underpriced share means, here UPS, underpriced share means, see, book value is more than the market value. Here, overpriced share means book value is lesser than the market value. See, I hope you are getting what is underpriced and what is overpriced. Select the underpriced share for better investment. Why? These underpriced shares, there is a possibility of increasing those shares in the market. So, market has not identified the real worth of that particular company shares. That is the meaning of underpriced share. So that I hope you are getting what is underpriced and what is overpriced. Here, after doing the careful analysis of the fundamental analysis and the technical analysis, finally we need to do underpriced shares, overpriced shares identification. What is underpriced shares? Book value is more comparatively market value. This is underpriced shares. So that we can identify the underpriced shares, so we can go for investing in underpriced shares. Overpriced shares. Book value is less, but the market value is high. See that at any moment of time, there is a possibility of correction. The share value may be go down. Here, market value is high because of the short-term demand and supply situation. The market value may be high comparatively the book value. See, these shares are overpriced. The shares are already overpriced. At any moment of time, it is going to be corrected. So that if you are already holding any shares of this kind of nature, so better to sell it off. Then we will see the situations. Book value is greater than the market value. This situation is called underpriced shares. So that we need to buy. Book value is lesser than the market value. These shares are called overpriced. You need to sell. Book value is equal to market value. You need to hold the shares. Whenever these situation may turn, book value is lesser than market value, then go for selling. Otherwise, book value is greater than the market value, you can continue with that. So, these are the ways of buying or selling or holding the shares. Now, look at the advantages of equity investments. After that, we can go for the disadvantages, or we can say risk element or the risk component in equity investments. Now go through the advantages of equity investments. Through equity shares investing, we will get the benefits of dividend, capital gain advantage, the bonus, the rights issue, and the liquidity. These are the various advantages for generating good amount of returns on equity shares. That is the reason why equity shares investment is a hot cake in stock market. Disadvantages, or we can say risks involving in equity shares investing. There is a possibility of the market risk. See, market may go up, market may go down. According to the market situation, your share values may increase or decrease. Industry risk. See, a particular industries may be varying according to situation. Say for example, it may depends on the political environment and the other import-export factors. There are various components involved in industry point of view. See, industry also having the risk element like business risk. There is a chance of the lowering the business in certain situation. In certain situations, the business may be done so that the earning capacity on that particular business may go down. The share value relating to that particular business may go down. The financial risk. They may be in debt trap. They may be in debt situation, so that their debts may be heavy comparatively assets because of in certain crucial situations the financial risk may arise. Residual claim. Equity shares having only the residual claim. In case of company closure situation, equity shareholders will get at the end, after clearing all categories of obligations, then only is there any balance left over, such amount only equity shareholders they will get. So out of all advantages and the disadvantages taken into consideration with a careful analysis and the observation with regular investment, being a long-term investor, no doubt definitely you will be a good investor and you will be ended up with fruitful results. In a capital market, long period, all risks are averaged and the returns are, you will get very good returns. Just follow the suggestions I have given here and having the habit of investing and minimize the component of spending, definitely it will help you a lot for your the future benefit. Investment, once again I repeat, investment is not a number game, it is a mind game. You need to keep it all precautions, you need to take it all kinds of issues before going to invest. So at the end, I would like to say one thing. Equity oriented investments are subject to market risk. There is no guaranteed returns. Keeping these two things in your mind, prepare yourself and go for investing. So have a good investment, be a good investor, and having a habit of investing regularly. I'm very happy for your patience listening continuously about half an hour. Thank you so much. Is there any queries relating to my presentation? You can contact this number. This is my WhatsApp number, or you can mail me. Definitely, I will answer your all queries. Once again, I repeat, thank you so much for your patience listening. Subscribe my YouTube channel, Gudipati Srinivasarao. Thank you so much. Signing out, Gudipati Srinivasarao. Bye bye.